Welcome to Talk Tickers. We're your home for cutting through the noise and really diving deep into the latest earnings calls.
That's right.
Today, we are zeroing in on Ryman Hospitality Properties, ticker RHP, and their Q2 2025 earnings call.
Yeah, this one's interesting. It's quite a story this quarter. A company navigating some, short-term market noise, but making these really bold strategic moves.
Especially in Nashville, right, which is always evolving.
Exactly.
So our mission today is to unpack how Ryman is using its, unique blend of assets, those iconic entertainment venues and the big convention hotels, to play the long game.
Even when some numbers maybe at first glance look like a bit of a mixed bag.
Right.
We've basically distilled the call for you. We're focusing on the key financials, management strategic thinking, and what it all really means for their future.
It feels like a classic case study,
Right.
How to look past the immediate headlines, understand the underlying currents.
Okay, so let's cut right to those headlines then. Because like you said, it was a mixed bag.
It was. Ryman actually delivered an all-time quarterly record for consolidated revenue. Handily beat analyst consensus. So, strong top line.
Can't argue with that. A record's a record.
But the bottom line, GAAP EPS fell short. Missed expectations by 17 cents, came in at $1.12.
And right there, that's often what makes a stock dip initially, right? That headline miss.
Yep.
But here's the crucial nuance, especially, for a REIT like Ryman. While that GAAP EPS missed...
That's generally accepted accounting principles.
Right. Standard measure, but sometimes less relevant for REITs. Their non-GAAP adjusted FFO per diluted share actually beat consensus.
Okay.
Came in at $2.35. That's about 4 cents higher than expected.
And FFO, funds from operations, that's often seen as a better gauge of a REIT's actual cash flow, right, from operations.
Precisely. It reflects the true health, you could say, of their underlying properties much better than GAAP sometimes. So you dig a little deeper, you get a different picture.
That's a really critical distinction for listeners. So operational cash flow metric. Stronger. We also saw adjusted EBITDA. Let's spell that out. Earnings before interest, taxes, depreciation, amortization, and real estate adjustments. Another key REIT metric.
Yeah, that one saw a bit of a year-over-year decline. Came in at $211.9 million.
Okay, so let's break down that record revenue. Total revenue was $659.5 million.
Which is a strong 7.5% increase year-over-year.
And the driver. This is compelling. A remarkable 52.1% year-over-year surge in their entertainment segment.
52% to $143.3 million. That's an all-time record for that segment. Huge.
Wow. Meanwhile, the core hospitality segment.
Yeah.
Pretty stable at $516.2 million, just a slight decrease, 0.6%.
So entertainment is really pulling its weight, and then some.
Definitely seems like it. Now, on the operational side for hospitality, same-store occupancy, it nudged up slightly, 74.0%.
Okay, filling more rooms.
But average daily rate, ADR and revenue per available room, RevPR, both saw marginal declines. ADR at $259.19, RevPR $191.70.
So filled more rooms, but maybe charged a tiny bit less, or just didn't see the rate growth maybe.
Yeah, something like that. A bit softer on the pricing power maybe in the quarter.
And this whole mixed picture leads us to the market reaction, which, often tells its own story.
It does. Despite that initial GAAP EPS miss and a brief intraday dip, I think it was 1.7% right after the call.
Yeah, a little wobble.
RHP stock actually rebounded by the close, finished up 0.75% and on much higher trading volume.
Which tells you investors likely processed the whole picture, right? They saw the revenue beat, they heard the strategy.
Right. They looked beyond the GAAP headline, especially for a REIT. They're looking at FFO, the assets, the strategy like Desert Ridge.
Exactly. They valued the underlying strength and that long-term vision. It shows the market can differentiate, between short-term accounting stuff and the real economic performance.
And speaking of strategy, the narrative was definitely dominated by one huge move.
Oh, yeah. The JW Marriott Phoenix Desert Ridge acquisition completed June 10th.
That's a big one. 950 rooms, massive meeting space, like 243,000 square feet.
And it wasn't a surprise target. They'd been looking at it. Management called it an ideal acquisition. Top 10 meetings market. Very strategic.
How did they fund that? Big price tag, I imagine.
Yeah, it was funded through a $625 million offering of senior notes, 6.50% due 2033. And they also did an upsized share offering, about 3 million shares at $96.20 per share.
Okay. And management's take was that it's a turnkey asset, meaning ready to go.
Pretty much. No massive overhaul needed immediately. And it helps with what they call customer rotation.
Right. Keeping groups within their Marriott portfolio, moving them between properties, enhances long-term growth options.
Exactly. And they have a plan. They mentioned leveraging the experience from their JW Marriott Hill Country acquisition, sort of a repeatable playbook.
Makes sense. What does that playbook involve?
Things like capital light enhancements, converting vacant office space into breakout rooms, which is smart, efficient.
Yeah, good use of space.
And they're even extending their ICE programming there for the 2026 holiday season, which is a huge draw at their other properties.
ICE. Yeah, people love that. So this acquisition should start adding to the bottom line when?
Expected to be accretive, so adding to earnings for the full year 2026 results.
Okay, so moving beyond the big acquisition, let's talk broader operations, the core group business.
Management sounded pretty positive there, highlighted a solid group pipeline, favorable supply dynamics for their kind of property.
And the forward bookings look good.
Yeah, advanced bookings for 2026 and 2027, showing robust group rooms revenue growth, like 9% and 10% respectively, with mid-single-digit ADR growth baked in. That's a strong long-term signal.
That does sound solid. But what about near term? Any softness there?
Well, there was one detail. For in-year bookings, lead volumes were actually down 16% year over year.
Whoa, 16% drop in leads. That sounds significant. How do they square that with a solid pipeline?
It's a great question. And they had an answer, a key nuance. While those initial leads were down, their closure rates.
Meaning the leads they actually convert to booked business.
Exactly. Those were up meaningfully, which resulted in a 3% increase in gross group room nights booked for the year.
Okay. So fewer tire kickers maybe, but converting more of the serious inquiries, higher quality leads perhaps?
That seems to be the implication. More effective conversion.
Got it. And what about spending at the properties? The out-of-room spend, banquets, AV, that sort of thing.
Still resilient, actually exceeded expectations once people were on site. It's a trend they've seen for a few years now.
And they attribute that partly to the investments they've made in food and beverage, meeting spaces.
Yeah, it seems like those upgrades are paying off. People arrive, they spend.
Okay. And the leisure side, transient travelers.
Leisure demand was up about 4% year over year. Strong performance at Gaylord Palms and Gaylord Rockies, which, they've recently invested in.
But there's always a but.
But Gaylord Opryland in Nashville saw some softness. And that brings us to a really important topic, Nashville market dynamics.
Oh, Nashville. Yeah, the Music City boom. Sounds like maybe too much of a good thing on the hotel front.
Well, that's the challenge. Specifically in the transient segment, people just booking a room for a night or two. Management talked about a substantial influx of new hotel supply.
How substantial?
Over the last decade. Roughly 15,000 new hotel rooms, plus about 7,000 Airbnbs.
Wow. That is a lot of new keys.
It is, and it's putting pressure on transient occupancy and rates right now. Simple supply and demand.
So how's Ryman viewing this? Are they worried?
Their public stance, optimistic. They view it as a temporary side effect. They're confident trends will reverse.
Why so confident?
Because the demand drivers for Nashville are just massive and still growing.
Yeah.
You've got the unique music tourism, obviously. The new Titan Stadium designed for huge events, Super Bowls, Final Fours.
Okay.
Massive development on the East Bank, Bridgestone Arena expansion, big corporate relocations like Oracle's $4 billion headquarters.
Oracle alone is huge.
And then there's the maybe more futuristic Boring Company piece, selecting Nashville as its second city, plans to connect the airport to downtown, potentially right through Opryland.
The Boring Company tunnels directly to Opryland. That would be a game changer for conventions.
Absolutely. A huge potential win. So Ryman is betting that all this demand will eventually absorb the new supply and then some.
Makes sense. But in the meantime, there's pressure. And didn't you say renovations are also a factor?
Right. Good point. The second half of 2025 will also see a RevPay headwind, about 350 basis points, just from renovation disruption at places like Gaylord Opryland and Gaylord Texan.
So definitely some short-term pain, or at least pressure, for what they hope is significant long-term gain.
That's the narrative. Now let's pivot back to that entertainment segment. Because while hospitality had some nuances, entertainment absolutely soared.
Right, the 52% growth. Opry Entertainment Group, EG, record revenue and record adjusted EBITDA.
Yeah, management sounded, quote, super bullish on the long-term potential, especially the festival business. They cited demographics, the capital light growth model.
Meaning it doesn't take huge buildings and investments to grow.
Exactly, and the artist reach. Even though they mentioned some bad weather hit festival attendance a bit in Q2.
And the Opry brand itself is going global.
Seems like it. First ever international show at London's Royal Albert Hall. They announced a special performance at Carnegie Hall in New York for Q1 2026.
Wow. Plus, NBC is re-airing the Opry 100 special. That's massive exposure.
Huge visibility, and behind the scenes, RHP is actively building out OEG's internal capabilities. New exec hires COO, CMO, boosting expertise in pricing, F&B, festivals.
Positioning it for what? Maybe a standalone future?
That seems to be the idea. Positioning it for potential future standalone operation, unlocking more shareholder value. And there's an Ateros purchase option related to OEG that starts in October. Could be significant.
Interesting. Lots of moving parts.
Yeah.
Okay, so let's tie this all together in an investor context. Guidance. They updated their full year 2025 outlook.
They did, incorporating Desert Ridge, but also that Nashville transient risk. They actually raised the midpoint for consolidated adjusted EBITDA by $15 million, now projecting $767 million to $813 million.
Okay, so higher overall profit expectation.
Adjusted FFO per share was trimmed slightly, midpoint lowered from $8.55 down to $8.21. Net income available to common also lowered.
So explain that again. Higher EBITDA, but lower FFO per share.
Right. It reflects the positive contribution from Desert Ridge, boosting the overall EBITDA, but the financing costs for that deal, plus the Nashville rate pressure, are weighing on the per-share FFO and net income figures. It's that classic interplay between operations and capital structure.
Got it. And Desert Ridge itself, what's it expected to add this year?
For RHP's ownership period in 2025, they expect $22 million in adjusted EV, factoring in seasonality and some minor construction disruption.
And the balance sheet overall. Still looking strong after the deal?
Yeah, it looks solid. $421 million in unrestricted cash, $1.2 billion total available liquidity. Post-acquisition, the pro forma net leverage is 4.4 times.
Which is pretty reasonable.
And they got a credit ratings upgrade the same day from S&P B+ to BB. That's a nice validation.
Definitely a positive sign. Capital spending plans unchanged.
Reiterated at $450 million for 2025, including some modest initial investments at Desert Ridge.
Okay. What about the bigger picture, the macroeconomy?
Management acknowledged things are very unpredictable. No surprise there. But they expressed cautious optimism for the U.S. economy over the next 12-24 months.
Expecting what?
More capital investment. A pretty decent economy for 2026-2028, especially, they noted, at the higher end of consumer spending. But their focus is on what they control, right? Efficient capital deployment, executing their plans.
Makes sense. So at the end of the day, they're sticking to their guns. Long-term, group-focused strategy.
Absolutely. Reaffirmed confidence in their 2027 EBITDA targets. And they plan to keep paying out 100% of taxable income as dividends, projecting continued dividend growth into 2027-2028.
So playing the long game, betting on their assets, the strategy, dividend growth for shareholder value.
That's the takeaway.
All right, now for a segment we like to include. This is purely for entertainment, for discussion. Let me stress. These are not investment recommendations. Always do your own research.
Definitely not advice. Just a fun thought experiment.
But if you're looking for an outrageous but plausible trade idea, maybe something for the adventurous listener. Here's one.
This one's definitely for the long-term thinkers, looking way beyond the current quarter.
We're calling it the boring Nashville bet.
Ah, I like it.
Consider a long position in Ryman, RHP, but with a really strong conviction that this Nashville transient rate pressure, it's truly temporary, just an anomaly.
So the trade isn't just about the hotels now, it's about the future infrastructure, that transformational development happening in Nashville.
Exactly. You're betting on the exponential demand growth Nashville seems primed for over the next, say, 5-10 years.
And the thesis is that Ryman's assets, strategically located, constantly being enhanced, are just perfectly positioned to capture that growth.
Think about it. The new Titan Stadium bringing Super Bowls, Final Fours, Oracle's $4 billion HQ driving corporate demand.
And the wild card, the boarding company tunnels. If they really connect the airport through Opryland, that's enormous.
Each one of those is big. Together, it paints a picture of a city really transforming its economic and tourism base.
So the bet is basically that the market today is too focused on the current temporary ref pay softness.
And underestimating the sheer scale of demand coming down the pike for Nashville.
Right. And maybe the stock's current valuation, reflecting some of those near-term worries, offers an entry point if you have that multi-year horizon.
It's a bet on Nashville's metamorphosis, really, with Ryman as the prime beneficiary because of its unique, hard-to-replicate assets, high conviction, long-term.
Definitely requires patience and looking past the immediate noise. But you can see the logic, the potential upside, if that thesis plays out.
And that pretty much wraps up our deep dive into Ryman Hospitality Properties Q2 results.
Yeah, we covered a lot. The Desert Ridge acquisition, the Nashville dynamics, both the challenges and the big potential.
And that really strong growth in the entertainment segment.
I think what really stands out is that reminder, beneath the quarter-to-quarter ups and downs, it's the strategic long-term investments, the unique assets that often tells the much more compelling story.
It's about vision, consistent execution, not just reacting to the latest headline number.
Well said.
Absolutely. Well, thank you for joining us for this deep dive. We really encourage you to continue your own research, your own analysis.
Definitely.
And if you have questions or want to explore these topics more, feel free to reach out.
And just that final standard reminder, all the information we provided today, it's for informational purposes only. It does not constitute financial advice.
Always consult with a professional. Thanks for listening.